Thanks for joining David, Kevin, Alex, and myself for the market update for the month of April. We hope you and your families are doing fantastic and enjoying some of this great weather. April was a really good month. It was the strongest month for U.S. stocks since November 2020, with the S&P 500 surging up 10.49% in April. Canadian stocks, as measured by the S&P TSX, was up 3.8% in April, and the European and Asian Pacific markets, as measured by the MSCI EFI, were up 5.04%. So all in all, an excellent month for all of us. I'm going to pass you over to the guys. They're going to do a little bit of a deeper dive, but as always, if you have any questions, please don't hesitate to give any of us a call. Take care.
April has been the most recent example as to why we as investors shouldn't overreact to short-term market volatilities. March was a dreadful month for stock markets. We saw the conflict in Iran start, and that had many investors fearful that this conflict could get ugly fast and that more negativity was likely to follow. But fast forward just 1 month, and all of the negativity that we saw in March has been erased and then some. Even though the conflict in Iran, it still exists, there's no concrete resolution to that conflict at the moment. The Strait of Hormuz remains blocked, and oil prices remain elevated. But the temperature surrounding the conflict has come down enough to where markets are now looking past the current situation with a renewed focus on business fundamentals like earnings and GDP growth.
That's absolutely right, Kevin. The US market has had a significant resurgence in April. As of writing this update on May 3rd, about 63% of the S&P 500 constituent companies have reported earnings for the first quarter, and 81% of them have beaten their earnings per share estimates versus the 5-year average of 78%. The magnitude of those beats, so how far above the earnings per share growth analysts expected, was about 20% beat margin. So it's been very strong for U.S. corporations in the first quarter of 2026. Now, valuations on a forward earning basis are about 21 times forward earnings. So, definitely not cheap, but given the level of growth that we've had, more or less in line with what one would expect. Concentration definitely continues to be a persistent theme, with the U.S. Stock market dominated by the mega cap stocks. Tech earnings have grown by about 43%, driven largely by the semiconductor chip stocks. This communication services earnings growth was up about 50%, largely thanks to Google and Meta or Facebook. Discretionary consumer spending was also very strong thanks to Amazon's performance. So mega cap tech continues to do the heavy lifting in the United States, and some concerns around concentration in the US market are bubbling back up to the surface again after seeing the Magnificent Seven stumble in the last few quarters. They've definitely had a resurgence here in the first quarter of 2026.
As we get closer to the US midterm elections, we wanted to touch a bit on what we refer to as midterm election seasonality. Now, from a historical perspective, the 12 months leading up to a midterm election have been historically pretty soft, with quarters 2 and 3 on average since 1990 being almost flat before seeing a fourth quarter rally after the elections are done. The 12 months after the elections have completed, however, have a completely different look. If you look at the chart on your screen, you can see that after a midterm election, the 3, 6, 9, and 12 months performance is incredibly strong, and that all 19 midterms cycles since 1950 have actually produced positive returns in the 6, 9, and 12 months after the election.
Thanks, Kev. That's definitely something to look forward as we head into next year. But to get through the rest of this year, for the remainder of 2026, it's clear that for now, markets have, looked over the valley of uncertainty caused by the war in Iran and the continued blockage of the Strait of Hormuz. as of recording this today on May 4th, there's reports that there's more military conflict in the region today. So again, it continues to be a persistent issue. We're going to have to see in the coming quarters, quarters 2 and 3, how higher energy prices translate to, maybe some inflationary pressure on the consumer in the United States, Canada, certainly in Europe. They feel gas prices being a little bit higher. So again, the jury's still out, obviously, on the market. Nobody knows what's going to happen in the short term, but this most recent recovery in April is just the most recent V-shaped recovery that we've seen. Since 2018, there's been a lot more V-shaped recoveries than historically. Usually you get more of a W-shaped recovery where there's a bad month, maybe it bounces a bit, and then we retest the lows again before ultimately moving forward. In the last decade or so, we've kind of been spoiled as investors. The recoveries have been very, the drops have been pronounced and the recoveries have been very quick as well. And so hopefully that continues to persist, that we continue to see markets be resilient. But again, April is just the most recent example of why we always preach for our clients to be patient, not overreact too much to what's going on in the world. And again, rely on that diversified portfolio that we've constructed for you to get you through the good times and the bad. But yeah, of course, if you have any questions, feel free to reach out to any one of us here on the team.
Take care.